You're watching Investors Guide on ET Now. Thanks for joining us on this long Easter weekend. It's our pleasure to have you on the show with us. On this show, we're going to continue planning your portfolios and answering your questions and helping you get richer. This is what we have lined up over the next half hour. We're going to look at the portfolio of a 35-year-old and tell him if he's on track to achieving his goals. We'll also review the Reliance Equity Fund a little later on the show, tell you if you should be investing in that fund at all. And finally, does opening a Forex trading account make sense for you as an investor? Find out later on the show. All of that coming up later on the show. First, let me introduce our guest, Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us on the show every week. Dhirendra, thanks so much for joining us. Let's get straight to our portfolio versus portfolio segment. Well, our first question comes in from Anirban Sengupta, a 35-year-old banker who writes in from Kolkata. He tells us he invests about 30,000 rupees every month in 11 equity mutual funds. Now, his current goals are to plan for his daughter's education and marriage and his own retirement. He also has to pay off a 15 lakh rupee home loan in the next 5 years, he tells us. He has a target of 3.5 crore rupees in the next 20 years to meet all of his goals. Now, let's take a look at his investments. He has about 60,000 rupees in his public provident fund account, about 1.5 lakh in the National Savings Certificate, 1 lakh rupees in fixed deposits and 50,000 rupees in the post office recurring deposit, which means about 9 lakh rupees in debt. The remaining, he tells us, he has a life insurance cover of 36 lakh rupees, a term insurance provided by his office of 1 crore and health insurance for his entire family of 2.5 lakh rupees. He sent us a list of his mutual fund investments as well. Like he said, there are about 11 funds in his portfolio, a copy of which you have. When you look at his portfolio, do you think it's tilted a little bit towards his debt portion with 9 lakh rupees in debt, or do you think he has a balanced portfolio to achieve his goals?
Yes, it is very much tilted to debt. But you know, as he keeps investing, if he continues his equity investments, and which is to the tune of about 29,000 rupees a month, so that will get reduced over a period of time. Also, I feel that his initial investments would have been these fixed income. He would have opened his PPF account and the NSE he will be owning, having the emergency fund in your fixed deposit. I think it's not too much. Yes, it's just that the fixed income savings they started a little earlier than the SIP he has got started with.
Okay, so what you're saying is that even though he has 9 lakh rupees in his debt investments right now, if he continues investing in equity, close to about 3.5 lakhs going into equity every year, over time that will even out, which means he should stop investing in his debt investments because 9 lakh rupees is enough. But if you look at his mutual fund investments right now, from that list of 11, my first question is, are they too many? And would you like him to, maybe redeem one or two or stop investing in one or two of those investments?
Yes, I think there are too many. And also, even if it's not too many, having so many, having 11 of them is just not making any meaningful value to his holdings. I would say that maybe he should benchmark to our aggressive portfolio, and there is a reasonable overlap here. He has, in fact, 3 or 4 of his funds are the ones we have it as part of our aggressive portfolio. So that is something he should have. And also, his first goal, his first requirement, that he needs the money for home loan repayment. That is a time when his appreciation, the interest accumulation in his PPF account as well as the NSE can be used partially to further reduce it, because our aggressive portfolio also has 10% into fixed income. So that will automatically take care of the automatic, or a methodical asset allocation. So that's the time. His fixed income, I don't think he should do anything about it. He should liquidate a part of it and be on that aggressive portfolio which has 10% into fixed income.
I follow our aggressive portfolio there. Those fund names are flashing on your screen. And remember, Anirban, when your PPF and your NSE comes up for redemption, you can use that money, like Dhirendra said, to pay off a portion of your home loan and maybe reduce that burden that comes in on you. Good luck with those investments. Of course, you can write back to us if you have anything else that you'd like to know. Let's move on now to our hold or sell segment. Some Manoj Shetty has written in our hold or sell segment. He tells us he's been investing in 7 mutual funds regularly through SIPs, and he wants to know if any of his funds are causing an overlap. He's concerned basically about the funds from the HDFC stable. He says he has 3 funds. He wants to know if he should exit any of these. The first 3 funds on his list: HDFC Top 200, HDFC Equity, and HDFC Prudence. Obviously, there will be an overlap, especially between Top 200 and Equity. Out of the 3, which is the fund he should hang on to?
I would suggest that depends on the time frame, but if his investments are for many years, then I think the one fund to have is HDFC Equity. I think across the 3 funds there could be 35 to 40% overlap, and here just thinking that having 3 funds is translating into greater diversification, that may not be the case.
Alright, so move on to the next fund on his list. We're holding on to HDFC Equity so far. DSP BlackRock Top 100 is the next on his list. 10% going into that fund. Should he continue investing?
Yes, it's an impressive large cap fund, and it should be held.
The IDFC Premier Equity Plan A is the next one on his list. Rain, hold on to this one as well.
Yes, this is a very impressive fund, and it is regaining its charm. Off late, it is just beginning to do well again, and yes, it is a must hold for a long term portfolio.
The ICICI Prudential Discovery Fund is the next one on his list. Hang on to this one as well.
Yes, a very impressive mid and small cap fund, and of course this fund and the IDFC Premier Equity are the 2 funds where he has to be patient with his holdings. When markets fall, these funds fall much more, but they are among the best mid and small cap funds.
And the last one on his list is the Birla Sun Life Frontline Equity. This is a fund that you recommend on a regular basis. 10% of his investment going into that fund. Hang on to this one as well.
Yes, hang on to this fund, and all his funds are good, but I think it's heavily big tilt towards HDFC fund, and once his other 2 investments are getting if he's stopping that, then the money should actually get spread over Birla Sun Life Frontline Equity and DSP BlackRock Top 100, and that will bring about a degree of balance across his holdings.
Alright Manoj, that's the advice going out to you from Dhirendra. Remember, if you missed anything, you can catch it on Facebook, facebook.com/investorsguide. That's our page. All of our archives will be on there. So if you didn't jot anything down, go to Facebook and take a look at the show. Also, you can write to us. There's an email ID at the bottom of your screen. We're going to slip into a quick break. On the other side, Dhirendra is staying with us. We're going to review the Reliance Equities Fund. Don't go anywhere. You're watching Investors Guide on ET Now. Thanks for staying with us. Dhirendra is still in the studio in Delhi, and in our fund review this week, we're looking at the Reliance Equity Fund. And before we start talking about it, Avan is here as always to give us a quick introduction. Avan.
Our fund in focus today is Reliance Equity. Soon after its launch, the market fell and the fund has been unable to perform during the subsequent rallies. In 2007 and 2009, it delivered below average returns when compared with any other diversified equity funds. Fortunately, it was able to shield its investors better during the market crash of 2008. This fund has delivered an annualized return of 7% since its launch. The fund's sector allocation mainly comprises of technology, energy, and financials. To give you a better perspective, we've done some simple calculations. If you invested 1,000 rupees in this fund when it launched, you would have 1,397 rupees today. With an average performance so far, is this a fund for you to invest in? Our experts are here to guide you and make an informed decision.
Thanks, Avan. Well, if we look at this fund, 7% return since launch. That's not very good, especially when coming from a well-known fund house. According to you, should investors avoid this fund altogether?
Yes, it is an extremely disappointing fund. It is a very avoidable fund, and It has been disappointing. If you look at the launch, and it was launched at a time, since then I think 40% of the time market has been on the rise. Not purely from the absolute return perspective that you have earned 7%. The key thing is that it has not been here is a fund which was supposed to invest in top 100 capitalized companies. So there's a far greater predictability. Here was a fund which was launched closer to the at a much higher market level, and the selling point was that it will help you navigate through the downturn, and it has not been able to do that. In fact, in all the years, it was able to do reasonably well in 2008 compared to all other years, but it completely misses all the upswings. In fact, in 4 of the 5 years it has existed in full calendar year performance we have, it has not been able to beat its own benchmark, leave aside other funds in the same category. So I think it has besides that, this fund raised a lot of expectations. It has lost 80% of its assets, and I think fund managers consistently have been under pressure to manage redemptions and manage the money more efficiently. So I think it is disappointing fund. Investors should avoid this.
So if there's an investor already invested, he's looking at redeeming right now, he's obviously lost a lot of his investment. What alternative options does he have in the fund universe?
No, there are plenty of options. We were talking about DSP Top 100 or HDFC Sensex Plus. There are many other impressive large cap funds where one should be investing in, and if nothing, then maybe going for an index ETF. That could be a better choice than this one, because it has not been able to it has been consistently underperformed its own benchmark. So having a Nifty ETF would have been a better deal.
So this is important to remember. Even if there is a new fund offer that's come out with a bang, remember to always invest in a mutual fund that has a track record, that is 3 to 5 years old, so you can check on its performance, because there's no telling that even if it's from a very reputable asset management company, there's a chance that the fund might not do well, like the fund that we're talking about. So finally, to wrap this up, Dhiren, your rating of the Reliance Equity Fund, give us a star rating.
I would give it a 1 star based on what it has delivered so far, and for the disappointment.
Alright, 1 star there for the Reliance Equity Fund on Investors Guide. Remember, Dhirendra, they're telling you to avoid that fund as far as possible. We have one last question, Dhiren, before we wrap up this segment. Vijay Ahuja has written in. He's 43 years old. He tells us he's been investing in mutual funds for a while, and his advisor suggested that he uses the STP instead of an SIP for an investment. Now, for those of you who don't know, an STP is a systematic transfer plan. So you transfer money from one mutual fund into another, and an SIP is a systematic investment plan. So you're transferring money from your bank account into your mutual fund. Now, his problem, Dhiren, is that he's paying an exit load on every transaction, and his investments are not growing, and he still has another 6 months of that STP to go. So he wants to know what he should do now. How can he cut his losses?
First and foremost, STP is a good idea, but he has been misled and misadvised by his advisor. STP works well when you have lump sum investment to make, but you want to average your investment. So basically, you invest your lump sum investment, make a lump sum investment in a fixed income fund. There, the likelihood of a market risk or a significant decline to your principal is very low, and then from there you move your money to an equity fund. And this is when STP works very well, when you have a lump sum investment and you don't want to invest at one go, but you want to get over with your transaction. You don't have to you don't have to really wait for your investment to be you don't have to monitor it, you don't have to do it month after month. But here I think he has been misled into this. His money has been invested into an equity fund where he is being levied the exit load, and it is moving into another equity fund, which I think is bad and injurious to his capital. And not only that, he will be liable for short-term capital gains as well if he has any. So he has got a bad advice. He should immediately stop the STP, evaluate his portfolio on a standalone basis, and see that if his portfolio is good. And if ideally, the best way to build a portfolio is to invest regularly, and STP is helpful when you have lump sum investment. But moving your money from one equity fund to another, to the third one by way of STP, I think he will be incurring exit load, and he will be liable for the taxes. It's a bad advice, and I think he should complain with AMFI about the advisor who advised him.
Alright, so this is the advice going out. Vijay, remember, you need to stop the SIP immediately. You need to evaluate your portfolio, and you need to change your advisor. Dhiren, why? Let's try and understand this a little better. Why would an advisor want to give this kind of advice? How can the advisor gain from making Vijay do something like this that's going to be so painful and so hurtful to his portfolio?
Uh, an advisor makes some upfront, he gets an upfront fee, even though mutual funds, equity funds are sold on a no-load basis. Uh, if somebody sells 1 lakh rupees worth of equity fund, then he will be getting about 0.75% from the fund company by way of initial the sales fee. And of course, the investor doesn't bear that, but it comes from the annual management fee which the fund company will be making. If that money was invested in a fixed income fund, the advisor won't get that because get that fee, because on fixed income fund companies don't pay that upfront sales fee to the advisor. Here, in fact, the advisor is making money twice. One, he has made the lump sum investment, and moving from one fund to another, he is making money again on the investment being made into the other fund. So this, I think, is cheating at the cost of investor, and he should immediately stop his STP and affect this.
Alright, Vijay, so that's the advice going out to you. Remember, your mutual fund advisor will make a little bit of money every time you invest in an equity fund. So what he's trying to do really is getting you to churn your portfolio, to move from one fund to another. So every time you move, he makes a little bit of money. You don't. It's bad for your portfolio and it's bad for your money. So the first thing you need to do, stop your STP, then take a look at the funds that you're invested in and find out what you need to do next. And of course, find a new advisor, find a new mutual fund agent. Like Dhirendra said, it possibly makes sense for you to also complain to AMFI if you can. Write to us if you need any more details. We'd be glad to help you out with this case. Dhirendra, thank you so much for joining us on the show and answering all of those questions. Remember, if you have questions for Dhirendra, you can write into us at the email ID at the bottom of your screen, and you can reach us on Facebook, Facebook/Investors Guide. We're going to slip into a quick break. On the other side, we're answering more questions about your investments. Don't go anywhere. We're back on Investors Guide on ET Now, and we have a special expert joining us today. Gaurav Mashruwala is a certified financial planner. He's going to help with some of your investments. Now, this is our first question, Gaurav. Thanks for joining us. Nandkishore Kulkarni writes in saying he's 27 and he's single and he has 3 dependents. Now, he's been investing in mutual funds through SIPs, and he also has some blue chip shares. Now, he has 60,000 rupees in his public provident fund and a term insurance cover of 14 lakh rupees, but no health insurance. Now, he saves about 50,000 rupees every month, and he plans to buy a house worth 80 lakh rupees in the next 3 years. He wants us to help him plan his finances so he can buy that house and also have about 70 lakhs in the next 20 to 25 years for his child's education and marriage that he expects to come up. And he wants to plan for his retirement. So there's 3 goals, and he wants us to give him a plan on how he can achieve this. Gaurav.
So one is the 3 dependents, I'm assuming, must be parents and a dependent sibling or something. Now, the first step that he should approach is health insurance, since he said there is no health cover. That's the first most important thing he should look to take it. I mean, he should look at first health insurance for himself and for 3 dependents, and then he's unmarried. So once he's married, for his spouse as well. The second step is life cover, because if he has 3 dependents already and plus over a period of time he'll have his family and dependent children and then other goals, 14 lakh cover is not sufficient. Now, it's difficult to put a number because we don't have complete data in terms of goals, the amount of money that he requires, but I would assume that somewhere in the region of 75 lakhs to a crore in form of term plan is what is recommended. So after these 2 are taken care of, which means health insurance and life insurance, next he should move to his immediate goal, which you have said is within 3 years purchase of house. Now, he already has some kind of exposure into equity. Now, if your goal is less than 2 to 3 years away, then ideally your assets should be parked in debt instruments. So he should move from equity based mutual funds into debt based instruments, or maybe a blended one where about 80% is into debt, or 85, and 15% into equity, or something like a monthly income plan. And then at the time of purchase of house, if he does not have enough capital to purchase a house, then borrow, take a loan, and then over a period of next 8 to 10 years repay that. His other goals in terms of children's education, marriage, I'm assuming since he's not married, once he gets married and has a family and children and then their higher education, so we're talking about anything more than 1.5 decades. So once home loan thing is settled, he should start a systematic investment plan into some equity based fund again, and then keep doing it till the time the desired goal is reached.
Alright Gaurav, our next question comes in from Naveen, who writes in from Bangalore, saying he's regularly been seeing ads on his email inbox asking him to start foreign exchange trading. Now the website, he tells us, asks him for $100 to start up initially, and then they would train him and guide him as well. He wants to know if he should be trading in forex at all, if it makes sense. Is there any literature available that he can read to start that trading? So as a retail investor, really Gaurav, does it make sense to trade in foreign exchange?
I'm not sure about the website and its authenticity, and I haven't checked, and I would not want to comment upon it because speculation and all. But trading in foreign exchange or dabbling is more from speculative purposes. I would not encourage anybody to get into dabbling into forex and more from trading, considering it as an asset allocation strategy or wealth building. So speculation is what he is seeking, or some kind of dabbling activity, then it's his call, but it's definitely not some kind of plan or way to achieve your future financial goals.
Well, I mean, not a good idea for you to be trading in forex, especially if that's going to be part of your financial portfolio. It's a little risky. Best advice would be to stay away from it. Our next question comes in from Kunal Joshi. He writes in saying he's 30 years old and he works as a senior manager. He can save about 15,000 rupees every month and he wants to start investing. His goal is to have a corpus of 25 lakh rupees in the next 25 years. Where should he be investing? All yours, Gaurav.
He has just said 15,000 is what he can set aside. Now we need to understand one thing. He's talking about suggest portfolio for ULIP, SIP, etc. Now these are not the asset classes. The asset classes are normally debt, equity, which are financial assets, and then we have real estate and bullion, which includes gold, silver, platinum, which are real and physical assets. So when you talk about investment strategy, when you create a portfolio, decide asset allocation for the underlying assets. Now to invest into these assets, there could be different vehicles. So one of the vehicle is ULIP, though extremely expensive currently. SIP through mutual fund. Again, mutual fund is a different vehicle which will help you invest. And similarly, you can do it directly by purchasing these. Now, since we are looking at long term, what he should do is choose equity and gold as an asset class. Now, in that, he can either take a mutual fund as a vehicle. Currently, the expenses charged by mutual funds are drastically less, and even the entry load has been kind of abolished. So he can start doing an SIP into a gold exchange traded fund, as well as an index fund to begin with, and over a period of time, as and when he gains confidence, he should shift to say a large cap fund and few actively managed funds. But investing 50,000 every month, and if he's looking at 20-25 years to build up a corpus of 25 lakhs, I think it's going to be a cakewalk. It should not be a problem.
Alright, that's a wrap on this show. We've completely run out of time. Remember, you can send in your questions to this email ID. We'll get back in touch with Gaurav if you have any more questions for him. Gaurav, thanks so much for joining us on this show. Remember, write in with as many details as you possibly can. It makes it easier for us to answer your questions. Facebook.com/Investors Guide. That's where you can reach us during the week as well. Tune in next week to catch Investors Guide. Thanks for watching.